Welcome back to Process Cast with Mark Anderson and Samantha Blake, your go-to podcast for insights into business process management and the technologies transforming the way we work. In this episode, Samantha and Mark dive into a business process you can import into your HEFLO account for free. Click the link in the description to get it.
Ever think about what happens after a business gets an invoice? I mean, It comes in, email, paper, whatever, and then what? It's not magic. The money doesn't just poof appear, right? No, definitely not magic. There's actually a pretty surprisingly intricate process that goes on behind the scenes to make sure everything's accurate and, legitimate before any money actually changes hands.
So that's what we're going to get into today. We're looking at a document all about something called the Accounts Payable Process. It gives us a really structured look into how businesses handle paying their suppliers. So we want to understand those key steps, all the different roles, and where those decision points happen, to actually get a supplier paid.
And it's really a fundamental part of how businesses operate, right? You have to make sure that you actually got what you paid for. You want to avoid any kind of fraud, and it helps manage cash flow so much more than just sending out money.
All right, so let's start right at the beginning. Our document calls it supplier invoice received. Seems simple enough. The bill shows up.
Yeah, that's the first trigger. And this can happen in a few ways. Like you said, could be traditional mail, could be an email. Sometimes it comes through something called EDI, electronic data interchange, which is basically a way for businesses to exchange those documents digitally, directly with each other.
Yeah, makes sense. So the invoice gets there. And what I found interesting is that at first the system just acknowledges it. Nobody's actively working on it yet.
That's right. It's kind of like a placeholder, that the system records that it exists, and that's really important for tracking and auditing later on. Basically says, hey, we've got this obligation and we need to deal with it.
Okay, so that's step one. The system's aware. When does a human actually enter the picture?
That's where the requester comes in. This is usually the person who actually made the purchase or received the goods or services. Their job is to submit the payment request.
So what do you think they have to put into the system? It can't just be the amount owed.
Oh, there's definitely more to it. They need to provide the full context. So obviously the supplier's name, the invoice number, the invoice date, that's crucial for identification. Then of course the amount that's due. And if there was a purchase order, like a pre-approved thing to buy something, they'd include that reference number. And usually a brief description, just to give some context for what it's for.
Okay, so who, what, and how much, basically. And the document even mentions some basic system checks at this point. What kind of errors are they looking for?
Think of it like a first pass, catching obvious stuff. Did they fill in all the required fields? Is there a supplier name? Is there a total amount? It might also look for duplicates. Has this invoice number already been submitted? Just a simple check to avoid paying the same bill twice,
Right, makes sense. So that's all submitted, and then it goes to analyzing the payment request. This sounds like where the real scrutiny starts.
You got it. This is where the finance team steps in. They're really the gatekeepers, making sure everything is legitimate and accurate before any money goes out.
Okay, so what are they analyzing? What are they specifically looking at? It sounds pretty intense.
Yeah, they're doing a thorough review. It's all about cross-referencing and verifying. First, they'll make sure all those basic invoice details match amount, supplier name, date, making sure it all lines up with what the requester submitted.
And then there's this thing called the three-way match. That seems really important. Why is that such a big deal?
The three-way match is super important. It's a core part of preventing mistakes or even fraud. Basically, they're comparing three documents: the supplier's invoice, the original purchase order, that's the authorization to buy the stuff, and then the goods receipt. That shows that the company actually received the goods or services. If those three all match up, quantities, prices, everything, then you have a really good indication that this invoice is legitimate.
So it's like a triple check, right? The invoice says 10 widgets, the order said 10 widgets, and receiving confirms 10 widgets. Boom, we're good.
Exactly, and the finance team doesn't stop there. They'll also check for duplicates, making sure this hasn't been paid already. They got to confirm the tax information is correct, compliance and all that. And they double check the payment terms, like when it's due, so the company doesn't get hit with late fees.
Wow, that's a lot of detail. So what if they find a problem? Let's say those three documents don't match up.
If there's any discrepancy, any missing information, they're going to send it right back to the requester. They have to figure out what's wrong and fix it. It's crucial to catch those things before the money's gone.
Makes sense. Okay, so assuming everything checks out, then we move to authorizing payment. And for some invoices, a manager has to get involved. Why that extra layer?
Yeah, so the document specifies that for anything over $100, a manager needs to sign off. It just adds another level of oversight, especially for those bigger expenses, making sure it's all within budget and follows company policy.
So what's going through a manager's head at this stage? What are they looking for?
Basically, they're making sure it all makes sense. They'll review the details, check that it aligns with company policies, that it's within the budget. They might verify the supplier, like, do we actually do business with these guys? They'll look at the purchase order again, the reason for the payment. Essentially, it's a second set of eyes to confirm that this is a legitimate and necessary expense.
And they can, obviously, approve it, but what if they have concerns? What can they do?
If something seems off, they can definitely reject it. That's the payment denied end event in the document. Could be because it doesn't follow policy, maybe information's missing, or if there's any suspicion of unauthorized activity. And they can also send it back for clarification if they need more information before making a decision.
Now, this is interesting. There's something called authorization timeout 3 days. Sounds like a fail-safe. What's that all about?
Yeah, that's a clever little mechanism. It's to prevent things from getting stuck if a manager doesn't get to the request right away. Basically, if 3 days go by without approval, the system automatically bypasses that step and moves it to wait for scheduled payment. It's all about balancing those controls with efficiency.
Makes sense. So the payment moves forward, even if there's a delay with the manager. Probably helps avoid late fees, keeps things running smoothly.
Exactly. Balance is key, right? You need those checks, but you don't want the process to grind to a halt. And the document even suggests that in a real system, this timeout might trigger an alert or escalate the approval to someone else, just in case it was missed.
Smart. Okay, so the payment's been approved, or it skipped approval because of the timeout. What's next? Wait for scheduled payment. That sounds pretty self-explanatory.
It is. Once the invoice has been reviewed and approved, or if it didn't need approval in the first place, finance basically puts it in a queue. The system just waits until the payment date rolls around. That's often determined by the payment terms on the invoice. Net 30 means you pay within 30 days of the invoice date.
So is anything actually happening to that specific invoice during that waiting period?
Not usually. Unless something changes, like a dispute about the invoice or the payment terms get adjusted, it just sits there, waiting for its due date. This gives the company time to manage its cash flow, so they're not paying before they absolutely have to.
Right. Hold on to that cash as long as possible. Okay, so the payment date arrives. What happens then?
That's when we hit execute payment. This is the actual moment the money leaves the company's account and goes to the supplier. Finance handles this part.
And how does that happen these days? Is it still someone writing a check and putting it in the mail?
Sometimes, yeah. But there are a lot of other methods now. The document mentions bank transfers. That's pretty common. And then there are electronic systems like SEPA, that's the Single Euro Payments Area, SWIFT for international payments, and ACH, the Automated Clearinghouse for domestic electronic payments. Depends on the supplier and what the company usually does.
And I imagine all of this is tracked digitally.
Oh, absolutely. Every detail gets logged. A payment reference number is generated for tracking, and often confirmations are sent out to both the requester and the supplier, just letting them know that the payment went through. Super important for accurate record keeping and auditing.
Okay, the money's sent. Suppliers got their payment. We're done.
Almost. We're at the final stages. The document actually lists 2 end events here: payment made and payment date reached.
So payment made seems pretty straightforward. It's the confirmation, right? Money's transferred, suppliers got it. End of the line for that invoice.
Exactly. That's the official sign-off for the whole accounts payable process for that specific invoice. Payment status is updated in all the systems, accounting, ERP, all that. Records are finalized.
And what about payment date reached? That sounds like something that would have happened earlier. What does it mean as an end event?
Good point. Actually, payment date reached is what triggers that execute payment step. It's like a condition that the system is always checking. Once the calendar hits the scheduled payment date for an invoice, boom, this event happens and the process moves to execution. No more manual input needed right then. So payment date reached is the trigger. Payment made is the confirmation that it all worked.
I see. Like setting an alarm clock, payment date reached, and then payment made means you actually got out of bed when the alarm went off.
That's a great analogy. So we followed that invoice all the way through its journey. from arrival to paid in full.
It really is a journey when you think about it. You just imagine paying a bill as this simple thing, but there's so much happening behind the scenes, so many different stages and people involved.
It really shows how important it is to have well-defined procedures and good process management, right? Every step serves a purpose: to ensure accuracy, to prevent problems, and to keep the company financially healthy.
Definitely. The requester, the finance team, sometimes a manager, even those automated system checks and timeouts, all playing their part. It's way more complex than most people probably realize.
And what's really fascinating is how this structured approach, even for something like paying bills, is crucial for efficiency and stability.
So thinking about all these different stages and the people involved, what would you say are some of the biggest potential problems? Where do things tend to go wrong in a system like this?
That's a great question. A lot of issues can come up right at the beginning if the requester doesn't submit the payment request correctly. Maybe they're not clear on what information they need. And any discrepancies that pop up during the analyze payment request stage, like those mismatches in the three-way match, can cause big delays because they have to be investigated and fixed. And of course, even with the timeout, bottlenecks can still happen in the authorized payment stage if those approvals don't get handled quickly enough. Clear communication, well-defined roles, user-friendly systems, all super important to keep things running smoothly.
It's pretty amazing when you see all the checks and balances in place, right? It's not just sending money. It's about doing it accurately, preventing mistakes, and maintaining good financial practices.
Absolutely. It's a process that most people don't even think about, but it's really crucial for how businesses operate and maintain those relationships with their suppliers.
It makes you wonder what kind of new technologies are being developed to make this whole thing even more efficient and streamlined. That's probably a topic for another time, though.
Yeah, definitely. The world of accounts payable is always evolving, trying to automate and optimize every step.
Well, this has been a really eye-opening look at what goes on behind the scenes of something we usually take for granted. Really shows the complexity of keeping the wheels of commerce turning.
It does. And understanding this process can give you a whole new perspective on something as basic as paying a bill.
So next time you're sending in an expense report, or maybe you get an invoice yourself, take a second to think about all the steps and the people on the other end who are working to get that payment processed. What kind of challenges do you think they face, especially as businesses grow and things get more complicated? It's something to think about.
Thank you for listening to ProcessCast. This episode was brought to you by HEFLO, the BPM platform that empowers businesses to document, automate, and optimize their processes with AI. Experience the intelligence to simplify complex business processes and accelerate your growth with our complete management solution. Visit heflo.com to learn more. Be sure to follow ProcessCast for more insights on business process management, and don't forget to share this episode with your network. Until next time.